Welcome back. Today on the Byte-Size Brief, we're going deep on ARM Holdings. We are doing a one-on-one, in-depth explainer on their massive strategic pivot right into the heart of artificial intelligence, and we're going to break down exactly why this company demands your full attention right now. Because, if you follow the semiconductor space at all, you already know ARM is absolutely foundational. But over the last few months, their entire trajectory has fundamentally changed.
Just think about this number for a second. 86%. ARM shares have been on an absolute tear, surging 86% year-to-date here in 2026, recently hitting a record high of $210.80. And look, this isn't just retail hype or a meme stock rally. This aggressive price action is largely being driven by a brand new AGI processor that they've co-developed with Meta. Basically, they are stepping out of the background architecture role and moving right onto center stage in the AI hardware race.
So, here is our roadmap for today's explainer. We'll start by defining their evolving business model, the architectural tollbooth, then break down the Q3 2026 metrics, weigh the bullish upside against the bearish risks like RISC-V, and wrap up with their future roadmap. Let's get right into it.
Okay, to really grasp ARM's current evolution, we have to look beyond their traditional model. In the past, they licensed basic individual blueprints to chip makers, but now they are rapidly shifting towards something called compute subsystems, or CSS. What does that actually mean? Well, instead of selling you the individual Lego bricks to build a processor, ARM is now delivering a fully configured, pre-integrated, and verified foundational block. It's almost ready to go right out of the box. This dramatically speeds up the time to market for massive cloud giants who desperately want to build their own custom silicon but don't want to start from absolute scratch.
And this shift is exactly why their bottom line is exploding. Think of ARM's old model like an architectural toll booth. They collect a few pennies, literally cents, every single time a traditional smartphone is manufactured. It's a remarkably consistent business, sure, but your growth is basically capped by how many phones people buy. The new model? It's like moving from collecting a tiny toll on the highway to selling the entire destination resort. Over in the AI data center space, ARM is now earning dollars per high-margin chip instead of pennies. By providing direct silicon solutions, they are fundamentally rewriting their long-term revenue trajectory.
So, how is this strategic pivot actually translating to their financials? Let's look at what changed since last quarter. Q3 2026 was, frankly, a major breakout. Total revenue climbed 26% year-over-year to hit $1.24 billion. Licensing was very strong, coming in at $505 million. But the metric you absolutely need to pay attention to is the massive 27% jump in royalties, hitting a record $737 million. This is huge because it proves that their higher-value intellectual property, specifically that newer V9 architecture, is rapidly gaining adoption out in the wild, and it's expanding their profit margins significantly.
Now, while that royalty jump is great, the real catalyst, the thing that really set off their recent massive stock rally, is this: ARM's very first self-designed AGI CPU for AI data centers. I cannot overstate what a massive milestone this is. For 35 years, ARM has never touched actual physical silicon. They just sold the blueprints and let everyone else do the manufacturing. Now, they are pivoting to produce direct, first-party chips. It's a total reshaping of their identity in the semiconductor market. And this physical chip matters intensely right now, because the entire compute bottleneck in the industry is shifting. Historically, basic AI training required a 1:8 CPU to GPU ratio. You just needed one CPU for every 8 GPUs. But as the industry charges toward autonomous agentic AI, systems that are running 24/7, actively making decisions and routing incredibly complex memory requests, that ratio is violently shifting to 1:2. You suddenly need vastly more highly efficient CPUs just to handle all that traffic scheduling while the GPUs generate the AI output. ARM is positioning itself perfectly to be the exact solution for that void. All right, so let's move into Section 1, the bullish upside case, and those key growth drivers.
The bulls pointing to the upside are looking directly at a few massive catalysts. First up is that new partnership with Meta to help train the Llama 4 model. Getting Meta on board provides massive, undeniable validation for ARM's data center ambitions. Second, remember that higher margin V9 architecture we talked about? It now accounts for over half of all their royalty revenue. It's scaling beautifully. On top of that, ARM's management has laid out a wildly aggressive forecast, targeting $15 billion in AI-specific revenue by fiscal year 2031. When you add in their near monopoly in edge AI and their dominance in the fast-growing software-defined vehicle market, the growth narrative here looks incredibly robust.
From a pure technology standpoint, this bullish upside is backed by the sheer horsepower of their new hardware. The new AGI CPU packs an astonishing 136 Neoverse V3 cores, and it's built on a cutting-edge 3nm manufacturing process. According to ARM, this setup actually offers double the throughput per rack compared to legacy x86 systems from competitors like Intel and AMD. And the kicker? It does all this while staying within the exact same strict power limits. For today's completely power-starved AI data centers, that level of energy efficiency is absolute gold.
But to remain totally objective, we have to flip the coin. Section 2, Bearish Risks and RISC-V. First and foremost, we have to talk about the incredibly steep price tag. Right now, ARM is trading at roughly 76.9 times its forward price-to-earnings multiple. To put that into perspective, this means the stock is essentially priced for absolute perfection. Investors are betting heavily that this entire data center transition will go off without a single hitch. If there is even a slight miss in upcoming guidance, or if there's a broader macroeconomic slowdown in AI capital expenditure, a valuation this incredibly high leaves zero margin for error. The downside correction could be very, very sharp. Then there's the crucial technological threat, and that's RISC-V. While ARM's architecture is totally dominant and ubiquitous right now, it still relies on those heavy proprietary licensing fees we mentioned earlier. RISC-V, on the other hand, is an open-source alternative. Now, historically, RISC-V's biggest problem was fragmentation, everyone building incompatible versions. But they recently solved this by standardizing something called the RVA23 profile. This standardization is a huge deal because it gives massive tech firms a viable, unified way to build custom chips and completely bypass ARM's licensing costs altogether. That is a massive long-term threat. And the bears also highlight several very real near-term supply chain and geopolitical scenarios. For instance, there's a looming potential for a 15% volume drop in the global smartphone market next year, largely due to memory constraints. While ARM claims this won't hit the royalties too hard, the reality is a high-growth stock simply cannot afford volume dips. Additionally, 20 to 25% of their total revenue was tied directly to ARM China. That's an entity they do not fully control, which creates massive, lingering geopolitical risk. And finally, don't forget SoftBank still owns a massive majority stake in ARM. The looming threat of SoftBank offloading large blocks of shares could persistently suppress the stock price, no matter how good the tech is.
So, how does this all play out? Let's move to Section 3, the Future Roadmap. Here is the immediate timeline you need to be watching. The most critical near-term catalyst was just yesterday, the May 6th earnings release, which is going to really set the stage for investor expectations on the new AGI CPU. Moving into the second half of this year, 2026, we're going to see the actual mass production of that physical chip begin. But the ultimate test, the true validation of this entire multi-year strategic pivot, will culminate in fiscal year 2028. ARM has set a monumental goal of having $1 billion in committed AGI CPU revenue fully locked in by then.
And that wraps up today's deep dive explainer on ARM Holdings. We've seen their incredible leap from just licensing smartphone blueprints to actually producing the physical engines of the AI revolution. But we've also unpacked the massive, sky-high expectations baked into their current stock price. For a sharper, more candid discussion on all of this, make sure to join us on the full audio explainer. In the meantime, I want to hear from you. Drop your questions and takes in the comments below. Does this aggressive AI upside truly justify that 76.9x premium? We literally read every single one. Thanks for learning with us on the Byte-Size Brief, and I'll see you in the next one.